Liquidity and volume are important concepts to understand when it comes to markets. The two are different but highly related, and both have very important implications for a market. So first, what is liquidity? Liquidity is the ease of which an asset can be bought or sold in the market without significantly affecting its price. For example, Adam wants to buy a $500 laptop using cash. Since cash is a highly liquid asset, Adam would be able to buy his laptop easily from any computer store at the desired price. But what if Adam doesn't have $500 in cash and wants to buy the laptop using his collection of rare action figures, appraised at $500? Well, you can already guess that it will be much more difficult for Adam to find a seller that not only has a $500 laptop for sale, but is also interested in his action figure collection. So in this case, due to the illiquidity of his action figures, Adam would need to wait for a much longer time to buy a $500 laptop, if ever. On top of that, he takes on the risk of needing to sell his action figures at a discount for a laptop worth less than $500 for a quicker deal. As you can see, liquidity is important because it allows traders to transact easily at their desired prices. Now let's look at volume. In financial markets, volume refers to the total quantity of an asset bought or sold over a specific period. Volume usually indicates the level of interest in a particular asset, where high volumes show higher participation and vice versa. One of the ways to visualize the liquidity in the market is on an order book, as it shows limit orders that buyers and sellers have placed. In an AMM liquidity pool, liquidity is indicated by the total amount of assets deposited in it. These are different from volume, which is only created when trades are actually executed. Most of the time, liquidity and volume is correlated, though they are independent variables in a market. Volume is a proxy indicator for liquidity, and high volume typically suggests high liquidity. But this is not always the case, and one does not cause or necessitate the other. For instance, a market with high trading volume can lead to increased liquidity as more traders are participating in the market. But on the flip side, a highly liquid asset could also beget high volume, as traders are more interested in trading it. Meanwhile, markets with low liquidity can lead to low volumes, as people are less interested in trading an illiquid asset, and low volume, indicating a lack of interest, can lead to people taking liquidity out of the market. However, high volume does not always equal high liquidity, as an illiquid market can experience periods of high volume, leading to large price fluctuations. And a market with high liquidity can still have low volume when there is little market activity. While both liquidity and volume are important for investors, liquidity is usually the first consideration, as it directly affects the ease of which the investor can enter and exit a trade. When liquidity is low, it tends to result in slow trades, high spreads, and slippage. However, volume is also vital for short-term traders, as they would want to be in markets that have a lot of participation and interest in the near term. Still feel like you need more to understand liquidity? Check out our previous video right here.